are going to move to the next test for the market rally. That's Wednesday's consumer inflation report. It's seen as the key to the Fed's path forward. Joining us now to discuss, we've got Leslie Falconio. She is the head of taxable fixed income strategy at UBS. We've also got Gus Faucher, the chief economist at PNC. Great to have you both on here. Gus, I want to start with you because it seems that the labor market concerns from earlier in the summer have really cooled off, and inflation and the stickiness of inflation is the bigger concern for the Fed right now. How vulnerable are we to a wake-up call on inflation this week?
I would be surprised if we see a significant acceleration in inflation. The progress has been choppy. We've had a little higher inflation readings over the past couple of months, but I do think that the drivers are going to be for slower inflation going forward. We're seeing slower wage growth in the economy, and then also we should see lower rental shelter inflation as we continue to see rent growth slow, and so that should bring overall inflation down over the next year or so.
Leslie, when you take a look at the moves that we've been seeing in the bond market, we got the yields right around 4.2. You take a look at this, has been really what we just heard from Gus, just in terms of some of those expectations moving forward. I'm curious what your assessment is just in terms of where we stand today heading into the new year.
Well, actually, I agree with what Gus said. I mean, we're looking for, inflation to trend lower, into 2025 as well for some of the points that he had mentioned in terms of owner's equivalent rent or insurance costs. But the market still has this, surrounding fear about the reacceleration of inflation, really ever since the Fed cut 50 basis points in September. And I think that that has really been the bond vigilante concern, and will be over the next several months. I mean, our expectation is that they cut 25 at their December meeting, and then they cut 4 times in 2025. But the market has really shifted to a much more hawkish sentiment with only about 60 basis points of cuts priced in for 2025. So we think that's a bit overdone. So we're actually looking for yields to come down in 25, not by a lot, maybe to around that 4% 10-year yield level. But I think that there's just still a lot of speculation and a lot of unknowns heading into the new year that are keep, I think, bond investors a little bit cautious, particularly on the inflation front.
Leslie, it sounds like you think the market is over-indexing on the risk of sticky inflation. What are investors missing?
No, listen, I think this has been just like a constant fear because, even in the first quarter of 2024, you saw a little bit of inflation move up. Obviously, some of these policies that potentially can be implemented are viewed as inflationary. We believe that anything tariff related, the Fed looks through as a one-time adjustment. But there's still a lot of policies that, could come in place in terms of fiscal stimulus at the end of 2025. And I just think there's this overwhelming fear about the reacceleration of inflation because as inflation has come down, we're not near that 2% target, and we probably won't be. And I think what's going to be key to the FOMC meeting is going to be the summary of economic projections, right? Their new sort of outlook on the economy. And the expectation is that more than likely they might increase their inflation expectation. And the market's also expecting them to take out, maybe a cut or something in their 2025 versus what they had in September.
Gus, when it comes to the factor of inflation with tariffs and just how real that factor is, how realistic that is, the timeline of that, and we're talking about it now, it might not come into effect here until 2026. I guess, how does the Fed walk that fine line, addressing it in the back of its mind, but also looking at some of the progress that has been made up until this point?
I think what Linda said is a very good point. Does the Fed view this as a one-time event where prices jump up because of the tariffs and then increase at the same slow pace that they had before the tariffs? Or do they think that the tariffs are going to lead to permanently higher inflation, in which case they need to keep rates higher for longer? My guess is they'll view it as a one-time event, but that's unclear. It depends on the extent of the tariffs and so forth. And so until we get a better sense of what's going on there, we won't really know how the Fed is going to respond to it.
Sticking with you on that, Gus, it's interesting to look at the optimism about the economy and how we've seen this switch in terms of Democrats becoming less optimistic about the path forward in the UMich data and Republicans becoming more optimistic. Where do we net out then in terms of how the consumer is feeling about the path forward for the economy?
Well, we're in a 50-50 spot in terms of the politics. So to the extent that Democrats are feeling worse, Republicans are feeling better, I think they're largely going to offset themselves. What I do think is that consumers are still in pretty good shape. We have a low unemployment rate, although it's up over the past year. Job growth is still good. Wage growth is running ahead of inflation. And when you look at consumer debt burdens relative to incomes, they look pretty good still. There are some households that are stretched, particularly some lower and middle income households. But generally, households are doing well. And then for upper income households, they're benefiting from higher stock prices and higher home values. So I think consumer spending is poised for continued expansion throughout 2025.